Marketplace Books and Traders Library are proud to present the Trade Secrets video series. When you're looking for new ways to boost your trading returns, these best-selling resources will give you the tactics, strategies, and ideas that will transform your trading. These books and courses give you the knowledge of highly respected educators like Jeff Greenblatt, author of Breakthrough Strategies for Predicting Any Market, Charting Elliott Wave, Lucas, Fibonacci, and Time for Profit. Oliver Velez, author of Strategies for Profiting on Every Trade and 5 Tactics That Beat the Market. And Tony Turner, author of A Beginner's Guide to Short Selling. All of the courses in our Trade Secrets video series are supported with an educational online manual. With this manual, you can observe the charts up close. And with our website, you can access this valuable resource at any time. Just log in at traderslibrary.com/trade secrets. Traders Library and Marketplace Books also feature a myriad of interactive multimedia courses in our Traders Education Corner. These course books come complete with the text, interactive test questions, online video presentations, glossaries, and downloadable charts. Make sure you visit traderslibrary.com/TLEC to learn more. To make sure you get the best price on these profit-boosting DVDs and all of your other trading resources, go to traderslibrary.com and sign up for our Rewards Weekly program.
Thank you. Thank you. So I've been trading the markets for about 22 years. I've been in this business 22 years. In many instances and in many industries, that's really not quite a lot. In this industry, I'm considered to be a dinosaur already. But 22 years trading, 16, almost 17 years educating traders all over the world in different languages. And it's really quite interesting to me that throughout my years as an educator and builder and developer of traders, I've taught nearly 100,000 traders over that period of time. I have gone to bed almost every night with that process with a mixed feeling. The mixed feeling is one of happiness and glee because I do something that I would absolutely do for free, and I just can't believe that people pay me for it. All right? The other feeling is one of a mild degree of disappointment. Maybe sadness is too strong a word. And I say that because throughout my 16 years of educating traders, I have come, more of them have not made it. And that's a permanent part of this game, that I have come in contact with people who want nothing more in life than to do this right. This is their dream, their number one passion. It is what makes them wake up with energy every single morning, and they don't make it. Now, what do I exactly mean by not making it? I'm not talking about becoming a little smarter. Most people do that. I'm not talking about becoming a little more sophisticated in your approach to the markets. Most people can do that. I'm not even talking about handling yourself a little bit better in the markets. Most people can get to the point where they handle themselves a little bit better than they did 2 years ago or 3 years ago. But I'm talking about the individuals who have a desire to do this consistently, and specifically the people who have a dream to do it as their major source of revenue, as one of their sole sources of sustenance. And the fact of the matter is that this game will always produce more losers than winners. It has to. And in a certain way, that's a very positive thing, because the opportunities for those who do get it are enormous, because the vast majority of people don't get it. If the vast majority of people started getting it, the profits would become commoditized and spread over a larger number of people, making it a less profitable activity. So for the smaller group who actually does get it, it's a wonderful thing that most people fail at it. But why do you think most people fail? What are the reasons? I mean, let's think of this for a second. The mechanics of the market, or any market, are very basic, very simple. Stocks, as an example, go up and they go down. Sometimes they pause, thinking which way should I, what direction should be next. But primarily, markets go up and down. If you were to think from a long bias, right, and you buy, all one has to do is prevent the buys that go down from going down by a certain amount, and to let the ones that don't go down run by a minimum amount. That's the whole game. In 30 seconds, I've explained the whole game that leads to success. You buy, you stop anything that goes down by a certain predetermined amount, and you let anything that doesn't go down run by a minimum amount. That minimum amount must be multiple times the amount that you allow it to go down. That's the game. All right. So why can't most people do that? Have any idea? It's hard to let go of your losses, absolutely. Ego. Discipline. Lack of discipline. I'm sorry? Emotional. All of these things you just mentioned tie into one thing. This game is so difficult because it requires that you conquer or master a very large portion of yourself. This is about self-mastery. This is not about really trading the markets. This is about you. Because if you can master the self, you can trade and you can do pretty much anything else for that matter. But how many people in life truly master themselves? Right? All of those things point to, I'm not able to do what I even know I should do. Right? And it's so hard because the mastery of the self is one of the grandest goals in life. I mean, it's what every activity is designed to help us do, to gain some level of control, to become an individual, to become enlightened or totally in control of ourselves and our surroundings. So I have a very interesting presentation for you. I will tell you that at the end of this 4-hour session, I'm going to make a promise to you that you will be able to go out to any market, whether it is the stock market, the commodities market, the Forex market, you pick it. It doesn't matter. These things are traded by human beings, and human beings are not different because you place a stock in their hands or because you place a commodity in their hands or because you place a currency in their hands. Human beings are the same, so markets are the same. You will be able to go out into any market, and I guarantee you, you will never play it the same again. I guarantee you at the end of this 4 hours, you will see the markets very different. I don't care how long you've been trading. I don't care how long you've been involved in the markets. That is my promise to you. And I promise that on the very next trading day, I strongly urge you to try to prove that what I'm about to share with you does not work on a consistent basis. You will not be able to do that. So what you get here today, in my opinion, is going to be enormously valuable and will revolutionize the way you play the markets starting the next market day. You will not have to develop this over time. This is not going to come 4 months from now or 4 years from now. I'm talking about the very next market day. And that is my promise to you. And I want you at some future point to come to me and say, Oliver, this does not work. You simply will not be able to do that. With that being said, all right, nothing will be overly complex. I'm a very, very big believer that the markets are simple. They are not easy. Simple's very different than easy, all right? But it's simple. They go up and they go down. And it's just a management of that up and down movement that really leads to consistent success. So let me just quickly give you a very brief introduction here. For those of you who are not familiar with who I am, many people know me as the founder of Pristine Capital Holdings, Inc. That's an organization, as John mentioned, I started from my basement apartment, Bronx, New York, September of 1994. When I started that company, I sent out a one-sheet research on 4 stock picks to one client. That client was Smith Barney, which became Solomon Smith Barney years later. Okay? That one client grew to thousands of clients a month later, and several years later, I developed the largest daily advisory service in the country. Right? Several years later, right, the teaching aspect exploded, and many of my clients wanted me to teach them how I came up with the stock picks that they were receiving in their research letters. Right? Enter the seminar aspect of my organization, which over several years became one of the largest seminar companies in the world, delivering over 400 seminars in multiple different languages on the subject of trading the markets for a living. Right? In 2006, I decided to take a break from my duties at my first company, Pristine, and start a new company called Velez Capital Management. This company was specifically created to focus on individuals and groups who wanted to take their trading to the next level, to become truly professionals, to make this the sole source of their income. Okay? I'm one of the most sought-after speakers on the subject of trading the markets for a living. And I have a number of international best-selling books. Probably the best, one of the most popular books in the trading industry is Tools and Tactics of the Master Day Trader. A 22-year professional trading history. I currently employ about 1,400 traders that actually trade my money every single day. Okay. I've been instructor for some of the country's top Wall Street firms and personal mentor to most of the experts in this field today. Okay. As far as Velez Capital Management, who are we? As I mentioned, it is a firm that's specifically designed to bring traders on to trade its own capital, my capital. All right, I'm the source of the capital. I fund every single one of my traders, and we have 1,400 now. And the firm brings on anywhere between 80 and 120 new traders every single month. These traders are spread globally throughout the world. All right, some trade through one or more of our 4 offices. Others trade remotely from home. But because of the heightened level of technology today, I can know precisely what every single trader is looking at, what every single trader is trading, what every single trader had for breakfast that morning, for the most part. All right, and that's where technology has brought us today. There are 4 offices around the globe, with many more coming on this year. And because of the enormous volume that our traders produce on a day-to-day basis, our firm enjoys an institutional rate that is rivaled by no other firm in the country. My traders trade for 2 pennies for every 100 shares they trade. So if they buy 100 shares, well, let's say if they short 100 shares of Google, that would cost them 2 pennies. And if they covered the 100 shares, it would cost them another 2 pennies, for a total cost of 4 cents. All right, that is unheard of. Many people are out there in the retail world believing that their $4 per trade, or $5 per trade, $2 per trade transaction costs are very low. Well, in the institutional world, that's extraordinarily high. And if many of my traders traded for $2 and $3 per trade, they wouldn't be profitable. They need the razor-thin, extraordinarily low cost structure to actually be profitable. So because of our volume, we have an enormously low commission rate, and the barrier that separates them from profitability is so extraordinarily low, they can easily shift their trading into the profitability category. This is Velez Capital Management's website, www.vcmtrading.com. All right, I strongly encourage that you peruse through the resources section. We have a variety of articles that I've written and some very informative things that I think can raise your level of market sophistication. This is a website that I strongly encourage that you peruse through too. Absolutely free content. It's vcmvideos.com. I'm one of the very few experts in the field who will allow you to watch me trade. All right, people come from all over the world to just simply watch me trade. This is a way for people to not have to travel to one of my offices to actually watch me trade. I record many of my trades, and while I'm trading, right, I am talking you through my reasoning, why I'm bidding, why I'm offering here, why I have orders below the market, why I have orders above the market, why I'm hitting the bid right now, why I'm sending the order through this route. And you'll see me put on positions anywhere between 2,000 shares and 25,000 shares and so forth and so on. This is the next best thing to standing over my shoulder and watching how a true professional trader works and sometimes manipulates market activity. All right, vcmvideos.com. Let me quickly go over what I've found in 16 years. What are the major obstacles that stand in the way of most traders who really want to take their trading to the ultimate level? Okay? There are 4 major obstacles. There are more obstacles than these, but these are the big ones. These are the enormous ones. Number 1, there is a lack of professional training. Now, that is distinctly different from a lack of education. We've got tremendous amounts of education out there. There's a book that comes out on the financial markets every single week. Every single week there's a new book coming out. There are articles written by the hour on financial markets and trading. There are 212 educational trading firms in America alone. Right? There are chat rooms and newsletters that are in the tens of thousands. There are TV programs. And of course, there's Jim Cramer. I mean, we have education up to the ears. What has been missing in the industry is professional training. That's very, very different from education. So while individuals over the last 10 years have become enormously educated about the markets, they have lacked the true professional training that really counts toward progress. And let me give you an example. We put our doctors in America through the appropriate training process. First, they go to school, they listen to boring lectures, they read anatomy books, they take exams and tests, and then they graduate from med school, but that does not make them a doctor. The most important part of their training comes after all the tests and all the exams, and that's called their residency. All right? And they must go into a real hospital, ladies and gentlemen, with real patients, real sicknesses, real problems, real blood, real life or death situations, real remedies, real medicines. And it is their rolling up the sleeves and dealing with real patients that elevates them to the point where they can truly say, I am now a doctor. That's the training that is missing in this industry today. You see, you can't learn how to trade sitting in this chair. You can't learn how to trade listening to me. You can't learn how to trade in a hotel room with cookies in the back and soda and a beautiful color manual. It is not the way you learn how to trade. Can you become a little more educated? Absolutely. Can you become a little more astute about the markets? Absolutely. But that's not the training that elevates you to being a truly successful trader. So you might be the smartest person out there about markets, but it certainly doesn't count when it comes to trading. What you need and what's missing is to roll up your sleeves and someone put money in your account, or you put money in your account, and you actually start trading, but under the guidance of a head doctor, under the guidance of a head trader. You see, because you can get the wrong training and blow your account out. I am talking about real live trades. A pilot becomes certified by spending time in the air. All right? A scuba diver, time underwater. A trader, your progress starts ticking the moment you enter into a live trade, and your palms start getting sweaty, and your P&L starts going up and down, and the butterflies happen. That's the process. The moment you exit a trade, the progress clock stops. The moment you enter a trade, tick, 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 you're progressing. The moment you exit a trade, your progress stops. You cannot learn. Let me go as far as this. You cannot learn how to trade studying charts. You cannot learn how to trade reading a book, not even my book. You can only learn how to do this by doing it over and over and over again, but preferably under the guidance of a professional. So I've seen so many people get highly educated but never make it because they lacked that training. That's how people at Goldman Sachs gets trained. No, they don't walk out after reading a book or sitting in a class and say, here's $100 million, go trade the US yen. All right? They're actually under the guidance of a head trader that watches their actions and corrects them and so forth and so on. There's been a lack of professional trading. Then there's been a lack of the right capital. Are you out there in the most sophisticated market on the planet that's played by some of the brightest minds on planet Earth with billions of dollars at their disposal with insignificant little pieces of money? Do you think you have a chance if you are not decently capitalized? Have infomercials made you believe that you can go into that world, pull food off their table with your little amount of money? I've seen people who even get the right training fail at this because they lack the appropriate amount of capital. So a lot of traders say, well, Oliver, what is the appropriate amount of capital if I want to kind of try to get myself started in this? I'd say it's hard to put a real number on it, but it's certainly not less than $50,000. Right? In fact, it's closer to $100,000, and that's just a starting point. So I believe that if traders are out there, first of all, not even having close to the appropriate training, and not even having close to the right amount of money, the odds are zero. Zero chance. And here's what's interesting. You need the right amount of money because the first move in every trader's journey is always down. Your first move is to lose first. You learn how to win by first learning how to lose in this business. And if you happen to be one of these traders, these beginners, who actually win first, oh my goodness, an accident waiting to happen. That is not how life really works in this business. It is not how life works, period. We put a seed down in the ground first, then it grows up. A dancer squats first, then the dancer leaps. A trader drops first, then he rises to glory. It's the only way. When you learn every possible way to lose, that's when you start learning. That's when winning starts happening. Winning is a byproduct of handling your losses appropriately. If you're winning first, where's the seasoning coming from? Let me ask you a question. If you bought a stock at $20 and it goes to $24, what did you do? Nothing but pray, right? Nothing. You did absolutely nothing. It took zero skill. But if you bought a stock at 20 and it drops to 19 and you kill it and now it's at 16, you had something called you to action. You had to make a very, very powerful decision, right? To cut your loss at a certain point, and now it's much lower. That took more skill than, should I take my $4 gain here or should I go for more? That takes very little skill. You become seasoned through your losses inside of every single losing trade. There's a gem. If you find it, you're moved down first, then moves you back to break even, and then you never look back again. If you don't have enough money to survive the dip that you will invariably go through, zero chance. Most people, right before they're about to turn, they're out of money. because they're not playing with the appropriate amount of capital. Okay? And then there's the lack of a forced discipline mechanism. I found this as a huge problem in my years of training traders. You see, everyone, this gentleman came out with one of the reasons why most people trade. He said, discipline, lack of discipline. That is something you hear generically all over this industry. You need to be disciplined. Lack of discipline is going to kill you. But see, the problem with that, it's too generic. The assumption in that statement is that you're supposed to be disciplined from day one. That is a farce. You are not disciplined from day one. Is a child out of the womb disciplined from day one? No. Discipline is earned. Discipline is learned. Discipline is developed over time. Your first foray in the markets, you are a baby. You are not disciplined and can't be disciplined, and no one should expect you to be disciplined. So you're going to go out there in an undisciplined state and learn how to do this. And that makes the odds against you. So the question is, well, Oliver, if it's impossible for me to be disciplined in the beginning, if I'm going to go out into the markets as an undisciplined individual, and you're telling me that you have to because discipline comes in the future, then what am I to do between now and the point at which I am disciplined? Lose? Yes. Now, lose appropriately is the key. You must lose appropriately, and the only way to do that is to have something or someone force right action on you during the time you are learning what right action is. While you're moving to the point where you can say, okay, now I'm disciplined, something must force you to do the right thing. Otherwise, you will blow out every single time. Because discipline is way in the future, and you're just going to lose on the way there, and maybe not even get there because you just lose too much. So without something that forces you to do the right thing, did you realize that oftentimes the right thing in the market actually feels wrong? And if you think about this, if you're losing more often than winning in the markets, if you're losing more often than winning, doesn't it mean that most of the time when you think you should buy, you should really sell? And that most of the time when you're selling, you really should be buying. If you're losing more than winning, you just got the whole thing backwards. What feels right to you is not right. So you need something that says, I don't care how you feel, you have to do this. And then as you do it more and more, as this thing, a piece of technology or a person forces you, the right thing starts to feel right gradually, which leads to the discipline. When you're about to make a stupid move, does your broker call you right before you hit the buy button? You're about to buy Google at $700, right? It's dropped from $740, and you think it's a buy, all right? And right before you're ready to buy this, does your broker call you and say, Mr. Johnson, please step away from the keyboard. You're about to make a mistake, all right? We do not want you to make a mistake. No, there is nothing out there forcing right action on traders. And then there's the biggest item of all, the fear factor. You see, real successful traders are fearless. They operate with zero. In fact, they're too far in the other category. Fear is a thing of the past for most successful traders. They do not experience it. They've left it behind. There is zero fear, and they're aggressive because there's zero fear. Fear is the result of knowing in your heart that I am not properly trained. Fear is the result of knowing that I am not properly capitalized, and there's nothing out there that's going to protect me from me. Fear is the result of knowing that you're your worst enemy and you can't stop yourself. And so you take fear into every trade. You bring fear to the market, and it makes you a timid participant. And let me tell you this, the market does not respect timid participants. The market does not respect people who try to be cautious, careful, right? Caution, I hate it. I hate caution. I'll explain these things to you. Well, I like aggression, but aggression has to be the state if you're applying your measure. So what I decided to do, is do my very best. I tried to come up with a model that squashed all of these things for my traders. I said, okay, look, I am going to train you. And how am I going to train you? You're going to sit right next to me. I'm going to put some money in your account. We're going to roll up our sleeves, and you're going to follow what I do. We're going to trade the markets with real money live. We're going to do it hundreds and hundreds and hundreds and hundreds of times a day, and you're going to get the real training that you're supposed to get through real trading. You're going to spend hours and hours and hours living inside a real trade. You're going to trade so often that trades are going to come out of your ears. All right? Decided to do that. Then I decided to say, listen, you're going to put your checkbook away. I don't want your money. You're going to trade my money. Let's put your money to the side. I am going to fund you. I'm going to put $50,000 in your account to start, and you can grow it from there. And then I'll go to 100,000, and then 300,000, and then 500,000. And my top trader today is trading with $40 million. Right? Then I said, but trust me, because it's my money, I am going to force you to do exactly what I want you to do. Because it's my money, I'm going to be your father. All right? And I'm going to force right action. I'm going to force the discipline on you. You see, if it's your money, I can't do that. But if it's my money, I can force you to do the right thing until the right thing feels right to you and there's no other coercion left. And then I'm going to remove fear and say, I'm going to take all the losses. I'm going to absorb all the losses. Well, I have to. It's my money. It's not your money. So if you lose, it's my fault. I'm going to take the losses. We're going to do this until we get it right. You're going to trade with me under my guidance, under the guidance of my top traders or whatever, and we'll do it till we get right. And don't worry about losses. They're all mine. And what I found when I started doing this, all right, I found the percentage of winning traders exploded beyond what I've ever been able to do in 16 years at this. I've always considered myself very good at helping traders reach a level of sophistication in markets where their actions start producing money. But I had no idea, by simply training and funding and removing the fear of loss from them, that you're not going to lose your money, what it would do. And let me throw some statistics behind that. What I found is that it was about an 8 to 12% success rate historically. So out of every 100 traders, only 8 to 12 made it. Now, a lot of them became better at their market play or whatever. I'm talking about making it to a very high level. With this, about 36 to 40 out of every 100 make it. Now, it'll never be more than 50%, but that's darn close. Darn close. So let me just quickly show you what some traders are doing under this program, and then I'm going to teach you exactly what I teach them to do every day to produce some of these progress. Now, understand that every trader I'm showing you now is a developing trader. They are still making silly mistakes. They are still doing the wrong thing at times. They still need slapped every now and then, which they get done, all right, through, closing down their system or having them not trade for the rest of the day and so forth and so on. So they get slapped that way. But they're getting it. They're getting it. Here's a trader that produced $10,200 in 2 weeks. And I want you to look at the gains here. These are the dates that the trader traded. This is October. This is this month. Okay? These are the orders placed that day. Okay? And these are the quantity of shares traded the entire day. Okay? Some days were more active than others. And you'll see the gross realized column, which is really what I want you to focus on. Now let's look at, on the first, this trader lost $520. That's okay. $74 the next day. Made back $258, and then he got his stride a little bit. So there's that dip, and then there's that rally. Okay? Up 4,500, up 78, up 51. Didn't trade these 2 days. Down $7,000. Net result, gross is $10,200. What did this trader do wrong? What's wrong? Yes, absolutely right. If you look at the average decent day, this loss is too big for the average decent day. Every trader has a different average decent day. If you, on average, when you have a decent day, make $1,500, your losses can't be $1,500. That's simple math. Your average losing day must be a percentage of your average decent winning day. Now, occasionally you can break that rule or whatever because something suddenly happens that's not in your control. But I'm talking statistically, you can't have $5,000 and $4,000 days if those are your regular decent days and have $7,000 down days. So what would you think would be more appropriate?
Control losses.
I'm sorry?
Control losses.
Yes, so what size of a average decent losing day? So I'm not talking about, see, this is a losing day. The decent losing days must be smaller than the decent winning days.
Like 10% of the decent.
Maybe that's a little too small. It's 10%. That's maybe a little too small. But I would prefer a third or so is okay, but I'm okay with half. I'm okay with half. Yes, sir.
Question. Are we looking at intraday trading? Are we looking at swing trading? Are we looking at long distance trading?
Well, the concept I'm trying to explain to you is applicable no matter what you're doing. So if you...
If I'm getting gains or losses on the 13th,
right.
did they start on the 1st?
That's right. These are all what you're looking at now are all traders that are trading intraday. Intraday. Absolutely. Absolutely.
13th is the day the market broke open on 400 points.
Uh-huh. Mm-hmm. So again, here's a trader who's making things work but still has work to do. So what I do is go over a 15, 20-day record and look at where I have to tweak the trader. So I'd have to create in his profile, okay, now I'm going to disallow a loss of this size. And I'm going to chip it down. So perhaps maybe in the system, I say, okay, this trader now can't lose more than 4,000. And I'll inch him down. As he starts to learn how to operate with a maximum 4,000 loss per day, then I'll move it down more. Maybe I'll drop it to 3,000. And when he gets used to operating with a maximum 3,000 per day, I just keep tweaking. You see, the trader, if he had to do that himself, probably wouldn't. And that's what we're talking about, the forced discipline mechanism. Let's move on to the next. Look at this trader, $30,000 in 12 trading days. Now, all of these traders are intraday. And I'll tell you why. They are in development. I train them from an intraday basis first, then move them to an overnight basis. All right? And in reality, there is no different. There's no difference. Instead of going multiple days, they just trade multiple hours. So every hour is like a day. Okay? And it's the same concept. If you can't handle yourself in an intraday fashion, you're not going to be able to handle yourself in an overnight fashion. Most people think that they do better overnight because they have the chance for the Hail Mary. Maybe the morning gap will save me. Maybe more time will save me. Well, I start my traders off in a little box, and if they can't handle with a little patch of grass, and you can't care for the little patch of grass here, I'm not going to give you more grass. You got to handle the little patch of grass, then you get more grass and more grass, then you get more hours, you get more days, and you get more weeks, and so forth and so on. We grow our traders that way. Now take a look, and this is all in your book. You may not be able to see the detail on the screen here, but look at this trader, $30,000 in 12 trading days. Now look at the gross realized again. All right, this is always my key here. Up $6,700 this day, up $6,000, up $10,000 the next day, good, down almost $19,000. Now that's very unacceptable for a trader at this level, but he starts inching his way back. What I teach my traders is that the moment you take a blow, step back and just practice black ink. I don't care if it's 2 pennies. Just get in the market and come out with something. All right? And just practice, because black ink, producing black ink becomes habit forming. So you start off small, $2, $5, $200, $100, $2,000, $3,000, whatever, and you inch your way back. So this trader took a blow. Now watch him inch his way back. Okay, up $1,700 that day, up 34, up 48, up 52, up 15. He did the inch back to profitability. He got back more than he lost. All right, which is good, but he inched his way back. He didn't try to swing for the fence after a blow to get the whole blow back. Then he loses 23. I am okay with that. See, the 23 for this trader is decent. It's an okay loss. But even then he starts inching his way back. So he took 23, okay, now he goes back to inching. Okay, made $1,600, made $1,300. And the total result is $30,000 in 12 trading days. But you see that these traders still sometimes get it wrong. When I loosen the reins, they still sometimes can't control themselves. So then I shrink it again. And then you have, this is another trader, $79,000 in 12 trading days. Okay? This trader didn't trade 9, 1, and 2, but traded here. Now look at this. This trader's all over the place. Down 47, down 17, up 15, okay? Down 28,000. But when this trader gets hot, he can produce a string of $20,000, $30,000, $40,000 days, like a string of them. And he did it a little bit here. Up 20,000 this day, up 20,000, up 30,000, down 12. A little too high for me, but okay. I'm okay with about half of your decent day, right? A decent up day, if you can keep your losses, your decent losses, half or less, I think you're in the game. You're in the game. Down 56, that's a more acceptable loss for this trader. But look at what he did. He comes back huge, up 46 grand. That was his savior. Okay? So this is a trader that, in my opinion, right now is less talented than the trader that I showed you before, even though he produces more money. Because this trader potentially is 2 days away from total disaster, right? If he strings 2 of those big days together, it's bad, okay? Or 3 days together, right? So he's so rocky that he's got to be restrained a little bit. And again, like I mentioned to you, they're inching forward. They're inching forward. $55,000 in 1 month. This is one entire month of trading. Look at the gross realized gains. Now this is very, very nice. Look at the gains: $1,700, $34, $4,800, $5,800, $15,000, down 23. That's perfect. That's perfect. I am more interested in how a trader loses than really how a trader wins. Okay? Up 16, up 13, up 12, up 26, up 34. Look at these little losses. Down 400, down 400, down 73. Boom, he comes back, up 3,800 that day, up 10,000 the next day, up 3,000, down 1,000. Great. Beautiful. That's what we're talking about. A trader who can let things run but will, no, this is too low. No, get out. It's just minding the weeds. The attention is more on the weeds, not on the roses. Let the roses grow. Just snatch those weeds. Do not let your trades get to the point where they start choking your roses, choking your $9,000 days, choking your $15,000 days. You keep those weeds tame. Okay. And then we have $11,000 in one trading day. Now, this is a very different report. I put this in here to show you to go inside of a day. One of the traders. Right? And so these are the symbols the trader traded. These are the shares, not all at once. You know, maybe the trader was trading back and forth with 1,000 share lots, 500 share lots, or what have you. These are the total shares that day traded. You can see that his big play was, of course, playing, this is on 1010, playing the spiders. All right? I'm sure you can realize, based on the time, that he's probably short SPY. All right, made $7,000 on that play and made small change on the others. A decent gain on APA. Okay. Trade $11,000 in one trading day. Again, all the symbols are here. This trader trades big lot sizes. Okay, made the vast majority of the gains on Cisco. Made $5,000 on Cisco that day, $2,000 on Yahoo. One trading day, again, going inside the day to see the symbols traded, the shares traded, and this I love to see. Now let's look at the gains on per play versus the loss per play. Up 28, up 5,000, up 4,000, up 17, up 500, up 6,000, down 1,000. That's acceptable. So even inside the day, I want the losing trades to be a small percentage of the average winning trades. And that's how you get, of course, your day to be like that as well. And then again, a lot of people say, well, Oliver, what kind of money are these traders trading with? Here's a trader, 8 days, produced $42,000 gross on a $270,000. I had $270,000 in that trader's account. All right, and that's huge percentages. All right. But look here. Look, this is decent, very decent. 8,000 this day, up 7,000, up 11, down 7. That's a little too sizable for me. Up 4, up 7, up 8, up 11. More acceptable to me is in the $3,000 to $4,000 range with this trader. Okay. And so if I start inching them down and say, okay, let's do a maximum of 6, now a maximum of 5, now a maximum of 4, and I gradually get the trader used to a smaller downside room. But first I give them the room and then I shrink the room. And again, look, $51,000 gross realized. Now again, you see the starting cash of $36,000. That's a little misleading because the cash is $36,000, but the leverage on that is far greater. All right, so we operate in a very highly leveraged environment, and this is perfect. Up 6, up 9, up 6, up 6, up 18, down 2, perfect. Up 1, down 600, perfect. Up 3, up 4,000, up 3,000, down 1,000. All of that's beautiful. This trader has got it down on lock. Okay? Give me 1,000 to 3,000 traders like this, I'll take over the world. Look at this. Look at this consistency. This is this is one of the most consistent traders I have. Look at the look at the gains. This trade is so consistent, ladies and gentlemen, that the gains are almost the same number. Look at that. Up 36, up 35, up 31, up 34, up 34, up 35, up 37. It's a robot almost. It's a machine. This trader's gotten to the point where his accuracy is like a machine. He's doing the same thing, getting the same results. Doing the same thing, getting the same results. Powerful. Powerful. I think last, you get the point here, guys. $72,000. Turn to $53,000 in cash. Again, highly leveraged, though. The cash is really misleading. The cash supports big leverage. okay? I produced $72,000 on a $53,000 account in 19 trading days. All right, and this trader, decent, although the 9 is probably, I don't like the $9,000 loss here. All right, but 4,000 is okay. 4,000 and less for this trader is okay. But you can see he can have he can have a string of very fat, profitable days, $10,000 days, $20,000 days. Okay. And so what I'd like to do now is I'd actually like to start educating you on what I am training these traders to do every single day. And as I mentioned, I believe and know you'll be able to put it to work the very next trading day, Monday. And I want you to put it to work Monday. It's just not going to start working for you as you practice it. It should start working immediately. It's simple and powerful, but simple enough for you to get it right now and not have to really have a lot of practice behind it. Okay? Now, it's necessary for me to start from the beginning and build you from the ground up as if you're a baby. So it may appear very simple and elementary in the beginning, but I want you to bear with me. We're going to build something really incredible, right? And your view of the markets are going to explode and change in some very, very beautiful ways. All right, ticks and bars. Let's go over this. There are billions of ticks that happen in the market every day. Tick, 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 billions. What is a tick made up of? A single transaction, commonly referred to in the market as a tick. It's made up of two things. What is it? Buy and a sell. Okay? Every transaction is a buy and a sell. So if every transaction is a buy and a sell, can you ever have more buying than selling? No. Can't ever have more selling than buying, right? Can't have more buying than selling. You can have more selling than buying. And that's the first erroneous notion we have to eradicate. It is never unequal. The buying is just as much as the selling and vice versa. It can never be out of balance. Okay? Now, there are billions of these ticks that happen every single day. Right? Billions of ticks that happen every single day. We pay the most attention to 4 of the billions of ticks that happen. We go out into this sea of ticks and pull out 4 ticks to place the most importance on, to focus our attention on. But there are billions of them. And these 4 are simply the open, the high, the low, the close. They're not the only ticks that happen, but they're the ones we pay the most attention to. Right? Open, high, low, close. But there are billions of other ticks that have happened. Now get this. The open, the high, the low, and the close is a function of your creation. You create the open, the high, the low, the close. You create it by determining a time period. If you decide to look at the market in daily slices, you're going to have an open, high, low, close of the day. If you decide to take this barrage of ticks and slice it up into smaller slices, let's say hourly pieces, so you take a pie and you slice it up smaller, hourly pieces, now you have an open, high, low, close every hour. Well, if you decide to really slice up the market into small pieces, 1-minute pieces, every 1 minute period, you have an open, high, low, close. You create the open, high, low, close. There really is no open, high, low, close. The market doesn't have lines. The market doesn't have divisions that separate one period from another. The market's just simply tick, 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 no lines. You create the division. You create the periods that say, this period stopped, that one began. So because this period stopped, that has a closing tick, and this one has an opening tick. But that really does not exist. It's a function of what you do. Now, this may sound like semantics, but as we progress, you're going to understand how important it is, because when you start to see beyond the lines, you start to see the markets very, very deeply. And I've always explained this concept like this. Let's say if you're looking at a scenery through a large window pane. Let's say this window pane is in your house and you're peering through the window into your backyard. All right? You take a crayon and you draw vertical lines every few inches on your window pane. Have you changed the landscape? No. What you've done is given it the visual effect of being in slices, because you drew crayon lines on the window. But what is behind the window does not have lines, really. Are you following me so far? All right, good, good, good. Now, we pay when we do create these lines and we say, okay, I want to look at 5-minute charts, so that now I'm slicing the market up into 5-minute pieces, all right? So that every 5-minute period I'm going to have an open, high, low, close. Okay? Once we've done that and have created the open, high, low, close effect, we must know which tick to pay the most attention to. The 4 ticks mean a lot, but the tick that means the most is the first tick of every period. The first transaction of every day is the most important transaction of the day. The first transaction of the week is the most important transaction of the entire week. The first transaction of this 5-minute period is the most important tick of the whole 5-minute period. You follow? It's the opening tick no matter what time frame you're looking at. Now, the closing tick has, or the last tick or closing tick is the second most important. And how we determine who is in control of the stock, if the current or last tick is trading above the first tick of the period, your assumption must be that buyers are in control of this stock right now. If the closing tick, the tick that is that where the market is right now, is below the opening tick, below the first tick of the period, your assumption must be that sellers are in control of the stock. And let me tell you this, if buyers are in control of the stock, you should be a buyer. If sellers are in control of the stock, you should be a seller. Now, a lot of traders say, but Oliver, what about the last bar? Forget about the previous bar. We base our assumption on who is in control based on the now, based on the current period, the period that has not finished trading yet. The period that has finished trading is like gone. It is like reading yesterday's newspaper. Why read yesterday's newspaper? We judge who is in control by the current trading activity. So, stock above the opening tick of the period, buyers are in control right now. Stock below the opening tick of the period, sellers are in control of the stock right now. And one final point, the further away from the open, the stronger the winning side. The further the stock is above the open, the more powerful the buyers. The further the stock is below the open, the more powerful the sellers. Understood? Very basic, I understand. But you'll understand, you'll see how powerful this is in just a moment.
I have a question.
Sure.
Wouldn't you think that, and this is everything I've read, everybody else sees this, but wouldn't you think that if the sellers are stronger, they're holding out for higher prices, that makes them increase in price, versus the buyers being stronger, they're buying at lower prices?
No, what I see, I understand your question. The question was, doesn't it make more sense that the buyers are stronger? The buyers are stronger when they're holding out to buy at lower prices, and aren't the sellers stronger when they're holding out to sell at higher prices, right? That, in a way, is true. But if the buyers want to buy at lower prices, but they're not getting lower prices, what are they then going to do if they still want the stock? Buy at higher prices. And that's what drives it higher. That the supply below the market is not there anymore, and there is no pullback, so they step up. And that step up, right, is very, very powerful. If they're no longer willing to wait for the stock to come to them, and instead they'll just say, okay, forget it, I'm tired of waiting, I'll grab it higher, that step up is powerful, and you've got to respect that. Got to respect that. So what drives a stock away from the open on the upside is the constant reaching for a stock higher. I'm not waiting. I want it now. Same thing on the sell side. Sellers would love for the stock to come up first, but if it doesn't come up, they're just hitting the bid and hitting the bid and just selling at the market, driving the stock below the opening price. And of course, the deeper the stock is below the opening price, the stronger the sellers. The further the stock is above the opening price, the more powerful the buyers. Okay? Now, this leads me to what I call Velez law number one. I teach my traders a series of laws or beliefs, if you will. Okay? My goal is to change your belief system. If you're not winning consistently, you've got the wrong beliefs. Belief leads to action. If you believe the stock is higher than where it is now, you're a buyer. If you believe the stock is lower, right, in a short period of time from where it's trading now, you're a seller. If you're getting trades wrong, your belief is backwards. And so it's my job to try to change your entire belief system. But before I start teaching you different beliefs, I will like to say this. Your beliefs don't have to be true. They just have to make money. All right? This is not about a search for the truth. If I can teach you a lie, but the lie makes you do the right thing, I'm going to teach you the lie. All right? This is not about what is actually true. It is about what works. All right? So if you've got to frighten your children to prevent them from opening the door to strangers, do it. There's a big giant monster outside. Don't open the door. Do it. All right? Whatever leads to right action. So belief number one, or market law number one, states the following. That during moving market environments, what I mean by moving market environments, a market that's not flat or stale, a market that has some degree of momentum to the upside or downside. During moving market environments, stocks and other tradable items follow through on their most recently completed color, 80% of the time. I'm going to repeat that again. During moving market environments, stocks and anything else that trades out there will follow through and continue the most recent completed color bar. And it will do it 80% of the time. What does this mean? If the most recent bar was green, there's an 80% chance that the next bar is going to be green. And if that bar is green, which means that it's traded closed above the open, there's an 80% chance that the next bar is going to be green. And if a stock closed below the opening price producing a red bar, there's an 80% chance that the next bar is going to drop. And if that bar closes red, there's an 80% chance that the next bar is going to be dropped. So bar by bar, you can know with an 80% accuracy what the next period should produce. You may not know what the next 3 periods produce, but with an 80% accuracy, you can know what the very next period should produce. Think about the power of this. If I just happen to be right with this, this is having tomorrow's lottery numbers. This is having, if you're trading a 5-minute chart, this is like having what the market's going to do in the next 5 minutes. If you're trading an hourly chart, it's like knowing what the next hour will produce. Okay. Did you have a question? Anyone have a question? Okay. Okay. After a green bar, expect another green bar 80% of the time. After a solid red bar, expect another red bar 80% of the time. Every time, no. 20% of the time, you're going to get a change of color. 80% of the time, you're going to get follow through. And it is this effect that leads us to our high level of consistency as a trader, knowing what the very next bar should produce. Yes, sir?
What history or study is the 80% based on?
About 12 years of actually going over different types of bars, and I have a chapter on this. I have a chapter on all the different types of bars and the percentage of times they should produce follow-through for you. And get this, guys, get this. I want you to understand that the more solid the bar, right, the higher the percentage. The minimum percentage is 80%. You can have a 90% chance of follow-through and even higher on extraordinarily solid bars. So what do I mean by solid bars? The further the stock is away from the 20, the more color in the bar, the more certain the follow-through. If the color doesn't represent most of the bar's range, that has less odds of follow-through. If the color is almost the entire bar, that's you're in the 90 percentile category. Okay? Now let's take a look at this for a second. Here's a stock that I want you to understand that the Japanese understood this concept thousands of years ago. They understood that the most important part of any bar's range is the space between the first tick and the last tick. That space does not always represent the whole bar's range, but it is the most important part of the bar's range. So in order to accentuate that part of the bar, they decided to draw a box around it to make that portion between the open and close stand out. And that's all Japanese candlesticks are, right? Boxes drawn around the open and close and painted red or green or black and white. That's all Japanese candlesticks are. There's nothing mystical about them. Yes, you can put fancy names on them and put them in packages and sell books and things like that, but they're boxes drawn around the open and close. It's simple. That's all it is. So here's a box drawn around the open and close and painted green. Green means that simply the last trade is higher than the first trade of the period, telling us that bulls are in control of the stock. This is a red box drawn around the open and close, which indicates that the last trade is trading below the first tick of the period or the first transaction of the period. Buyers are in control, sellers are in control. Based on my law, what should happen next? That's right. What color bar? A green bar should happen next. And of course, based on my law, a red bar should happen next there. Now, this leads us to something extraordinarily important. Once the bulls produce their color, green, they maintain control as long as they keep more than half of the green that they produced. If the bulls allow more than half of the green to disappear, they no longer have control of the stock, even though the bar may still be green. In order for the bulls, in order for us to give the benefit of the doubt to the bulls, they must keep the green healthy. If they allow the green to drop by 55% or more, the bears have just taken control. Even though at the 55% level, that bar is still green. So bulls stay in control of the stock as long as they maintain most of the green that they produced. All right? And it is only in that scenario that the 80% follow through comes into being. If the green drops to the 55% mark, there is no follow through. You will not get another green bar. There will be no percentage of a move up. In fact, you have just flipped. The odds are that the next color is going to be red. Does this make sense? The bulls must maintain 55. The bears, who have dropped the market from the open, below the open, they have produced solid red, the distance between the open and close. They must maintain most of the red in order for us to have that follow through. If the bears lose 55, that's the magic number, 55% or more of the red disappears, they have lost control. The baton has been passed to the bulls, and now the odds are that the next bar is going to be green. Now I just want you to follow this for a second. I want you to imagine that the green has dropped, and ended with a little bit of green left right there. What's above you? A tail, right? So a little bit of green is there above you. Why did that stay green? That's where it stopped, but why did it end green? Because the bar stopped, right? Make sense? So let's say it's a 5-minute bar. It was losing its green, losing its green, losing its green, losing its green, ding dong, ding, 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 saved by the bell. If that bell did not stop, that bar would not be green. It would just keep going. Do you follow? So the stopping of the bar, who did that?
Time frame.
Who created the time frame? You did. So is it really green? Do you see when you see beyond the crayon line on your window, you start to see a little deeper? That even though that bar stopped, I made it stop. It really doesn't stop. That bar is not green in your mind once it's lost 55%. You've got to think red. All right? If 55% of this bar goes or more, the red starts being eliminated. Red starts getting eliminated, and the bar stops with a little bit of red. If that bar didn't stop, it would just keep going. So in your mind, that's not a red bar. Not when it loses more than half of the redness. You've got to think the other way. And don't get tricked by the bar stopping and the next bar starting, because the market doesn't have stops. These ticks are going on tick, 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 tick. You draw the line. So it can be moved. The line can be moved. Now, one last thing to drive this home. I know I'm kind of beating a dead horse, but it's necessary for me to drive this nail as deep as I possibly can, because we start flying from here. If this is a 1-minute bar, 1-minute chart, this is a 1-minute bar that rallies all the way back up and leaves only a little bit of red, and then the next bar starts and then keeps going up and produces green, okay? If I moved, and that's 2 bars, right? So 1 bar finished with a little bit of red, the next bar went green. That's 1 minute and 1 minute. If I erased the line and made that a 2-minute bar, what would it look like? It would go total tail and then green, right? So do you see how in your mind, if you shift the divisional lines, you can create anything you want? Seeing the markets deeper this way will lead to better action, because it's not as simple as red bar should produce another red bar. Only a certain type of red bar produces another red bar. A red bar that has maintained almost all of its red. It's not that every green bar produces a green bar. No, the green bars that have hung in there strong and maintain almost all of their greenness, they follow through. So if you were long this stock, where would your stop be? There you go. Your stop would be at the 55% mark, because that's the point at which the buyers die. If I'm short, my stop is 55% of the way back into the red, because that's the point at which the sellers die. They lose their strength. Yes, sir.
More than 55% of the open, as opposed to more than 55% of the low.
Well, actually, no. It's 55% of the way back up from the low, because wasn't that red? So it already started coming up a little bit, right? So where's about? So what I do is as a quick and dirty rule, where's halfway from here to the open? Where's halfway and just a little bit more? All right? From the high now, wasn't this high green? Then it came off the high a little bit, right? So from here to the open, where's halfway and a little bit more? Now, I don't want my traders out there. I don't want you out there with rulers, all right? That's not how I want you trading, or calculators. But it's a general area. It's an eyeball, okay?
I was just thinking, reading your books, this is a much clearer way to put it than change of guard at the top.
Absolutely, absolutely. I agree with that. Yes, sir.
We're talking about from the high to the low, not the candle itself.
From the open to the high on a green bar, or the open to the low on a red bar.
You didn't just say the low is already coming back?
Right. So, for instance, here's the open. At the low, this was solid red. From the open to the low was solid red. It lifted off the low a little bit. So it's already come back part of the percentage. Okay? You follow what I'm saying? So, but at the low, when it was at the low, this part was red. So you measure from the low to the open, what's the 55% mark? And here, on this bar, it's just the reverse, right? When this was trading at the high, it was solid green. So it's already given back part of the 55%. Part of it is given it back already. Okay?
But you have a nice round candle.
It's beautiful.
How about if I had a long shadow on either up or down?
Well, that's the whole point.
Throw it all out?
Well, you know what? I think this is going to be clear if I go on, but that's the whole point. If this green drops to that 55%, you will have a long shadow. And that 55% mark tells you that the buyers have just died. All right? Now let me move on and watch how clear this comes in. But so let's assume that because you believe that this bar ended nicely green, solid, the bulls held on to the power, now there's an 80% chance of follow through, I'm going to jump on board the beginning of the next bar. That's not a bad thing to do. If there's an 80% chance that the next bar is gonna shoot higher, I would jump on board with an 80% chance of win. 20% of the time, I have to murder the stock. Fine. You mean 80% of the time I'm gonna walk to the bank, and 20% of the time I'm just gonna shoot the stock? I'll take those odds any day. All right? So, but the open is always neutral. You do not buy until you get a little bit of green. So if you're going to buy after a nice solid green bar, let the next bar open. Do not do anything at the open. And then once it produces a little bit of green, you need a little bit of confirmation that this follow through is in fact happening. Boom, 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 boom. You jump on board. Your stop is 55% back down into the previous green bar's range. Okay? Now, this means that if my stop is based on a little bit more than halfway into the previous bar's green bar. I've bought here, my stop's here. This is an acceptable dip area. This bar can dip into the green bars, the previous green bar's range, as long as it doesn't penetrate the 55% level. Okay? Before a dancer leaps, he must first squat. Sometimes stocks need to squat before they take off. We want an allowable squat spot or space.
Second bar, gaps down, opened up in the middle of the green bar.
Okay?
But then I start seeing green on it. Am I waiting till it's over the high of the day before?
Not necessarily, but gaps do bring a very special or different scenario to the game. But yes, if the stock opens lower but did not trigger the 55 and then starts coming up to produce green, you can buy. Where's your stop? 55% level. Okay? Now, same thing on the sell side. If this bar ended nicely, decent red, you don't jump on board at the open. You let the next bar open. If it produces some red, you can start slamming the stock short. Where's your stop? 55% of the way back up into the previous red bars. Now get this. You don't keep your stop there. As the current bar grows, you move your stop from the 55% to under the bar that you just bought. Now you're protecting not the previous bar's green, you're protecting the current bar's green now. So as the stock grows to an acceptable size, move your stop under that current bar. Now this bar has not finished trading yet. It is still trading up and down, but the separation between the first trade and the current trade, that separation is getting wider and wider. Now, when it gets to a point where you say, it would be stupid to lose all this green, and then part of the previous bar's green, jam it up to under the current bar's low. Same thing short. If you short it here, all right, your first stop was there. As the current redness starts to grow, all right, you move your stop on top of the current red bar. Let me ask you this. Let me see how many of you are getting this. If this bar keeps getting bigger, where do you think you move your stop?
Half of
There you go. Excellent. If the current bar continues to grow in size, you will move it from under the low back to the 55% rule. If you get a nice sized green bar, if more than half of that green bar suddenly disappears, the bulls have died. So I put my stop at the die point. But you can't move that too quickly. The green bar has to get decent enough where a drop of 55% or more is a major wipeout. Okay? So I teach my traders to track their trades just like that. Here's the sequence. Enter 55% of previous bar, 100% of current bar. Bar grows, 55% of current bar. Next bar starts, grows 100% of the current bar. That bar grows 55% of the current bar. Next bar begins, next bar grows 100%. So it's 150, 55%, 155%, 155%. And you just track your winning play bar by bar like that.
In a market like this,
Yes.
with volatility is ridiculous. Okay, most of us are not paying 2 cents a trade.
That's right.
Okay.
2 pennies a trade.
Well,
Right, okay.
is there any Do you have to accommodate
For the excessive volatility?
just not to get closed out?
Yes and no. And again, your questions are great. I do have it covered.
Okay.
All right, I do have it covered. So what I'm teaching you now is once you get into a play, you can literally bar by bar read and know what is likely to happen in the next bar, what is likely, and then you'll know how to adjust and where to adjust based on your stop levels. Now, this is the most important chapter I'm going to cover today. All right? If you forget any other chapter, make sure this is not the chapter you forget. All right? I want you to think about this. There are only 13 bars the market can produce. I'm going to repeat that. There are only 13 bars in existence. There's not 14, there's 13. I'm going to teach you how to identify each one of the 13 bars, and more importantly, I'm going to show you and demonstrate to you what each bar should produce next. That's the game. If you can get what should happen next right more often than wrong, that's your key to success in this game. Each bar has a specific statistical odds of producing something next. If you know that, then you'll always be statistically superior in knowing what should happen in the very next period. So let's go over the 13 bars. Of the 13 bars, there are 5 green bars and 5 red bars. The other 3 bars that make up the 13 are no color bars. But I want you to understand, there are no other bars the market can produce. This covers everything. The market has 13 notes to create its symphony. It has 13 letters to write its book, its novel. All right? This is it. These 13 letters make up the words, the sentences, the paragraphs, the chapters of all that it says and does. Now, bars number 1 and bar 6 are the most powerful bars the market can ever produce. Bar 1 is totally a solid green bar from open to close. Almost all the bar or all the bars range is solid green. It doesn't have to be totally 100%, but almost 100%. And then on the red bar, this is almost entirely a red solid bar from the open all the way to the low. Almost the entire bar's range is red. You cannot have more powerful bars than this. This is the granddaddy of all bars. The odds of follow through after a bar like number 1 is extraordinarily high. Upwards in the 90% category. The odds of a follow through to the downside after bar 6 is almost the closest you can get to certainty. Is it certain? No, but it's the closest you're going to get to certainty that the next bar is down. Okay? Now, let's go to bars 2 and bars 7. This is the second most powerful bar the market can ever produce. I want you to think of what's happened here. The stock opens at 40, drops to 39. At 39, it is solid what? Red, which means it's bar number 6, right? At the low, it's solid red, which means that at the low, that's bar number 6. So think of bar number 6. Think of what this does. We've got bar number 6. Now, all of a sudden, right, this bar's not finished trading, the red starts to disappear. Half the red's gone. 55% of the red's gone. When we get all the way back to the open, all of the reds disappeared. But it doesn't stop. It goes beyond the open to produce the opposite color. Oh my goodness. What an incredible comeback story by the Bulls. Not only did they wipe out 55% of the red, no, they wiped out all of the red And didn't even stop there. They wiped out all of the red and went to produce their own color. Now that's power. You've got to bet long after a bar like that. All right? Same thing here. This stock opens at 40, rallies, let's say, to 41. At the high, it's solid green. It's bar number 1. And then the bulls start to slip. They lose 20% of the green, 25, 30, 50% of the green, 55%, they're dead now, but the sellers don't stop. All of the green gets disappeared at the open, and then they don't even stop there. They go beyond the open to produce their own color, red. The bears not only wiped out all of the green, they started producing their own color, and that is pure, unadulterated power. You've got to assume down after a bar like that. These 4 bars have the highest odds of follow-through of any of the 13 bars. The highest. Okay? Now, bars 3 and bars 8 are your normal bars. They're decent bars. Let's not trivialize them because I use the word normal. They have a normal odds of follow through. Yes, this bar, most of the range is green. It's not particularly long range, wide range, but it's a nice, decent green bar that will probably go on to do its job the next bar. Nice, decent, red bar, all right? Nothing to be overly excited about, but will probably produce a red bar. And then you have bars 4 and 9. They're the ones that I call the neutral bull and bear bars. Neutral because of 2 things. Number 1, there's only a speck of green or a speck of red. And that speck of green and red happens right in the middle of the bar's range. So this is green only because the bar stopped before a few ticks turned it red. You follow what I'm saying? So in reality, you can't look at it as a green bar because if you gave it a few more seconds, maybe it would be red. It just happened to, your bar ended and it just happened to be green at the time. So we don't know with bars 4 and 9 what are next. What we need after a bar 4 and after a bar 9 is another bar to either break the high or low. So if the next bar breaks the high of bar 4, that's when I know the bias is up. If the next bar breaks the low of bar 4, then that's when I know the bias is down. So after bars 4 and 9, you need more information from the next bar. That information is either the crack of the high or the crack of the low. Okay? After bar 1, are you going long or short? After bar 7, are you going long or short? After bar 4, are you going long or short? Right, you don't know. You need the next bar to break the high or crack the low. Okay? After bars 3, going long or short? Long, probably. After bar 8? Short, okay. What about after bar 5?
About 5, it is 5. You go,
Short. Think about this. This stock opened at 40, rallied to 41. When it was at 41, which bar was it? 1. Now, it has lost more than half of the green that it once had. The bulls are dead. That bar is only green because it got saved by the bell. But the bulls have been knocked out. The odds are high that the next bar is red. And so you can actually let the next bar open. Do you do anything at the open? No. If it starts to produce a little bit of wet, just smack it on top of its head. It's going down. Okay? Now, if the next bar should be red after 5, what should the next bar be after 10? Green, right? This stock opens at 40, drops to 39. At 39, it is bar number 6. It's solid red. Then the bears start to lose their redness right here. More than half, 55% or more of the red disappears. Sellers are dead. Bulls are in control of the stock. Next bar is green. That's got to be your bet. This is not a game where you're going to be right 100% of the time. All you do is need to be right more often than wrong, and the rest of the game is money management, trade management, stop placement. That's the rest of the game. Find something with a decent degree of accuracy. Doesn't have to be great. Decent accuracy. The rest of the game is trade management. Okay? You can literally walk up to a chart. Whoa, look at that solid green bar. Next bar I'm going long. Stop at the 55% level. You'll be right 80% of the time. You'll be wrong 20% of the time. If you do the right thing with the 20%, the 80% will take care of you all by itself. All by itself. You buy a stock at 20, and then it goes to 24. You have done nothing. The stock did that all by itself. You buy stock at 20, and it drops to 16, but you sold at 19, that's when your talent comes into play. You have to be the most talented with the 20%. The other part happens all by itself. Okay? Now, let's look at the last 3 bars. Last 3 bars have no color. Bar number 11 is the most neutral bar you can have. It's a bar that ends, the open and the close are the same, and the open and close are right in the middle of the bar's range. You have no color to go by. You have no range point to come up with your bias. It's in the middle of the range and it's no color. What's next? You don't know. You need the next bar to take out the high or take out the low. Okay? Now, neutral bar. What bar should happen after 12? You should know this now.
Red.
Excellent. Red. Do you all see that the next bar should be red? Yes. This bar opened at 40, rallied to 41. At 41, it was bar number 1, solid green. Then, get this. The green started to disappear. At one point, bar 12 became bar 5, right? It was bar 1. It started losing its green. It became bar 5. And then it became bar 12. Yes? And if it keeps going, it's going to become bar 7. So you see how the bars morph into each other?
Yes.
Okay? They morph into each other. This bar, if it starts losing almost all of its red, number 6 will become number 10. And number 10 will become 13 if it keeps going. Okay? And if it keeps going from 13, it's going to go back to number 2. Okay? Now, what could you do right now? If you had to act right now in this bar, what would the choice be? To go long or to go short right now? Short. Excellent. If you had to act right now, long. If you had to act now, wait. All right. Excellent. I think you guys have got it. Can I throw one rule in? I'm going to throw one rule in that's going to make this very powerful for you. I train my traders that at every 55% retracement level, at every 55% of a loss of green or 55% of a loss of red, I want you to act right then. If, let me show you. You have bar 1. Bar 1 becomes bar 5. They're shorting right now. Their stop is above bar 5's high, right above it. Okay? They short before this bar actually finishes. The more conservative is to wait for the next bar to open and then give you a little bit of confirmation. That's the more cautious approach. But I told you earlier, I'm not a big fan of caution. Not if you've got something that works. The difference between a trader that makes $2,000 a day and a trader who can produce $20,000, $30,000 in a day is that the $20,000, $30,000 trader knows when to put everything on the line, knows when to press the pedal all the way to the floor. That trader knows when to empty the pockets and put every single chip on the line. That trader knows when to step up and be aggressive. The other trader's never aggressive. Both profitable, both successful, just different levels. When you have something that works, knowing when to pile in, when to put it on the line is very, very key to being way beyond mediocrity. Yes, sir?
Are we assuming in this like that the 10 where you would think that, like reversal?
Of course, absolutely. You're going to go long after a bar like this. Now, you can do this simply blindly with no reference of trend or anything, but I'm going to perfect it for you by incorporating those things. But right now, we're just at the bar stage. Ladies, gentlemen, there's no other bars possible. You have just learned the only 13 things the market can throw at you. Market can throw you bar number 1, give you bar number 5, give you bar number 13, but it can't give you anything other than one of these. And knowing what is likely to happen next is your key. You've got the whole market covered with 13 bars. And knowing how to play each one. I'm shorting with the stop above the high. I'm going long with the stop where? On number 10. Where's my stop? I'm going long with the stop below the low. All right? I'm going long with my stop at the 55% level. I'm going short with my stop at the 55% level. I'm going long with my stop at the 55% level. See, to me, this up movement is all green. Think of every movement up producing green underneath, and every movement down producing red above. All right? Let's go on to this. And then I think I'm going to give you a break after this chapter. How bulls and bears lose control of one bar. This is the most important chapter in the course. All right, I'm going to say that at every chapter. You realize that, right? All right? Okay. All right, now, here is absolute control. What number of bars are these? Powerful. 1 and 6. Powerful. Absolute control. You can go long, you can wait for the next bar, you can go long the same bar if you like, stop at the 55%, stop at the 55%. Now, this is how this control can be lost. You can go from absolute control, or here's a full control bar. I like full control bars. They're not the absolute variety, but they're the really powerful variety as well. Most of the bar is color. Most of the bar's range is green. Most of the bar's range is red. It's solid. Follow through is almost assured, or as close as I can get to assured. Beautiful. But then you can go from full control to what I consider good control. What's good control? Still, more of the bar's range is red, or more of the bar's range is green, but a portion of the redness or greenness has been evaporated. The bulls were at one point at the high. They have given back a portion of their glory, a portion of their strength, a portion of their power. The bears at the low were in solid control. Now they have good control, not as powerful as they had, but it's okay. Still, they're maintaining most of their color. And then you can have weak control. This is where the bulls, by definition, still have maintained a little bit more than half, but it's shaky. The bears had much more glory at the low. Their hold on to control is very, very slim now. And once the 55% trigger happens, they have lost control. But Oliver, the bar is still green. We know that in reality, we look at this bar as red. It's green because time stopped that bar. If time did not stop that bar, it would be red eventually. Lost control. What, if you're aggressive, and I want you to be, what are you doing right now?
Short.
And where is your stop?
The high.
Excellent. And you're going long now with the stop below the low. Excellent, excellent. Lost control. Now here's where I'm going to give you a rule that is going to take your profit level to a much higher level. If you enter on a 55% retracement event, and I want you to, if you enter on the 55% retracement before the bar finishes trading, okay? This bar is still trading, but you just shorted it. This bar is still trading. You just went long before the bar stopped trading, right? If the same bar reaches the 100% level by wiping out all of the color, I want you to double up. Please write that down. So think about this, guys. Your bar has lost 55% of the green. You just shorted. If it keeps going on the same bar, if it keeps going and it gets all of the green, add. I teach my traders to double and sometimes triple up. But it must happen on the same move. If 55% or more of a solid red bar has been erased, you go long. If it keeps going and reaches the 100% wipeout level, double up. Now, it may not. If it doesn't, you just keep a one lot in there. The reason why I do this, I've found that the moves that happen when all the color disappears are bigger and stronger than the moves that happen when a portion of the color disappears. It's more powerful. And we get heavier in plays that statistically give us more powerful moves. I will not double up if the 100% mark has not been reached on the same bar. But if it has, I'm doubling up. And some of my real aggressive traders will actually triple up on it at the 100% mark. Now, guys, listen. I want you to understand why this works. The next page or slide shows you why. If every move up in your mind is green, produces green underneath, and every move down produces red, when you have a 55% retracement, what color controls more of the bar? Red, right? So if you think the halfway mark, right, makes everyone even, then 55, there's an imbalance. Okay? So if I had my choice and I created a charting package, and I'm actually thinking about doing this, there will be no tails. Got it? that every move is going to be a color, and I think it visually helps a trader know who's producing more color than the other side. Bears are producing. The move down was bigger than the move up. The move up was bigger than the move down. I gotta go with the bigger move. Okay? So that's why this concept works. The stronger side is the buyers. The stronger side are the sellers. Clear? Okay. Now, this is where you get all of the color disappears, right? So, didn't at one point here, this was all green. We lost 55%. You went short. We reached 100%. You're doing what? Double down. Absolutely. This was solid red, 55% retracement. You go short. It reaches 100 on the same bar. You add to the short, add to the long again. Yes, sir.
This is regardless of what I did yesterday.
That's right.
Because if I'm using my 55% as my cutoff,
That's right.
I'm not only getting out of the trade, I'm getting in another trade going the other way.
You can, but I'm going to add to that. I promise you. I promise you. All right, we're going to, because see, what I did is I building you up from a tick to a bar to all 13 bars. And when you got that part right, then we put it together in a flow where, okay, now I only want you taking the longs under this scenario, taking the 55%, 100% retracement longs under a set of circumstances, and taking the 55%, 100% shorts under a different set of circumstances to really jack our odds up. And we're going to get there. We're going to get there. But you could literally play this bar by bar, irrespective of anything else. And the accuracy would be there. You can, guys, listen, this is, I teach my traders this. Now, remember I told you, your beliefs do not have to be true. They just have to produce right action. Right? So if I say there's a monster outside, don't open the door, that may not be a monster, but if the right action is not to open the door, it works. Okay? If I say there's a fire in the house, get out, and the right action is to get out of the house, whether there's a fire or not, produce the right action. So, look at what I'm saying here. You have had a solid green bar lose 55%, you short it, drop to 100%, you short it, then it went the opposing color. It kept going beyond the 100%. I'm telling you that when this happens, the bulls will never win again, ever. The bears are in control of this stock after a bar like this from now all the way to zero. The bulls will never come back, ever. Now, is that true? No. No, of course not. But if you think it's true, you'll have the type of aggressive play that we really want. This is so bearish that that the stock will not see this high for a long, long time. That's got to be your belief, because a high percentage of the time that's true. It's got to be your belief so strong that, oh boy, I just found the final high forever. And if that's the case, how will you play it then? If you really, really believe that. You get a bar like this that not only wiped out 55% of a nice solid green bar, it wiped out all the green and then, wiped out all the red, then start producing green. This low will never be seen again. That's not true, but it's closer to true than not. You've got to be so confident when you see a bar like this that low, I've just found a final low. This thing is going to Pluto. Okay? And that's got to be your approach. That's got to be your approach. Now, John, are we all right, and we're ready for lunch? Now, okay, let me just close out before we break for lunch. Because when we come back, we really start to put this whole thing. What I've taught you so far are 2 entry points. 55% entry, 100% entry. If the bar is a decent size, enter on a 55% retracement. If the bar is little, you got to enter on what? A 100% retracement. Okay? So if I got a little bar, and I'm saying, but where is the 55% mark? No, you can't do that. You got to do the 100% of little bars. But if the bar is nice and decent, 55% erasure of any solid color bar, excuse me, is your go. If it gets to the 100% on the same bar, you add to the play. Now, those are your two entry rules. Your stop rule uses the same percentages. 55% of the green you want to protect. All right? 55% of reds. If the bar is little, you go to 100%. If the bar starts to grow, you move from under to the 55. If the bar is little, you can go under the whole bar. If the bar starts to grow, 55. And you track it that way.